We continue to be positive on the infrastructure and REITs sectors here in Asia. If you look at the infrastructure segment, governments are forced to increase infrastructure spending for the next couple of years. In the past few years, if you look at how the GDP is constructed, you have your consumer spending, you have your private investments, and you have your net exports, three components. And these three components have been weak for the last couple of years. The fourth component is your government spending, and that is within the control of the governments to try and ramp up investments into the infrastructure space to boost GDP growth. If you look at how the ASEAN countries have projected the amount that they've projected to increase, you're looking at $120 billion per annum spending for the next couple of years to 2020. Within the REIT space, we continue to be positive on it. If you look at the Singapore REITs, they will deliver the highest dividend yields globally. And if you look at some of the sectors that we think will do well, these are the industrials and the retail sectors. Within the industrial sectors, why we prefer it is because of the business park. Some of them which have a business park exposure, and within the next few years there are no new business parks in Singapore. Within the retail space, we like the REITs which have exposure to the best assets, the best retail assets. So for example, here in Malaysia, that would be your Mid-Valley Mega Mall and Gardens assets, and which is held by IGB REIT. In Singapore, that would be your VivoCity Mall, which is the largest mall in Singapore, and that is held by Mapletree Commercial Trust. In Hong Kong, there is Festival Walk, one of the better performing malls, and that is held by Mapletree Greater China Commercial Trust. So those are some of the REITs that we like, and they do deliver dividend yields from between 6 to 7%, and we are still positive on that sector. For this year, the investment strategy for the fund is to focus on a few areas. Within the infrastructure space, that would be the toll roads, the airports. We're looking at the renewable space in China. We're also looking at the telecommunication space around the region. And why we like those assets or the sectors is because, firstly, there is a rebound in growth. Secondly, these are generally monopolistic or oligopolistic sectors, and we believe these assets will do well this year. Within the REIT space, two sectors which may do well in the future would be the commercial and the hospitality space. So in Singapore, in the last 2-3 years, there's been a oversupply of office space as well as hotels. But in the next 2 years, the supply will drop dramatically, and we think that these two sectors will have a rebound in rentals as well as hotel rates. The fund gives investors exposure to two very unique asset classes. Within the infrastructure space, we are confident that it will deliver medium to long-term growth, given that the assets are monopolistic and oligopolistic, and they operate here in Asia, where growth is much higher than the rest of the world. For the REITs, they will deliver very decent and high dividend yields, and we believe that they will do so for the long term. And both asset classes, if you looked for the past 5 years, have delivered performance or returns which have been higher than the broader market, and they have achieved this with lower volatility than the broader market. The fund has been able to deliver good returns for the past 5 years and at low volatility. As such, we believe that investors can use this fund to complement their existing portfolio holdings.